Good evening, everyone. I would welcome you all to ICI session on financial management. I think we are beginning with the subject today. So it's a very exciting day for me as well as for you guys. We'll be starting with this new subject, which has no, you know, initial start in any of the previous subjects or even at CA Foundations. It's a brand new subject for all of us. And I'm pretty sure that we're gonna all enjoy this subject. This subject being very close to my heart, very dear to me right from the day I stepped into CA Inter, because that was the time when I actually got introduced myself to this subject. So excited. Let's begin with this subject of financial management, guys. So the subject is financial management, and today is a session of discussion about what's the scope and objectives of financial management in the first half before we take a break. And post break, we will discuss about the various sources of finance. Okay. So without wasting much of our time, let's get started with the subject of financial management. So we are talking of the word financial management. Now, this subject comprises of two words. One is the financial part, another is the management part. So when we talk of this word financial and when we talk of this word management, the subject can be broken up into two parts, or I can say into two segment. The title we can break it up. Financial talks about something related to money. Okay. Even if I ask you the question, what do you mean by financial? All of your answers are going to be like in terms of money, right? Definitely. Now, when we talk of management, what do you really mean by this word management? What's your understanding about the word management, guys? Tell me something about the word management. What are your thoughts about management? What do you think management is all about? Yeah. Okay. I know some of you might be answering it's the art of getting things done by others or done from people, right? So our father of management, Henry Payol, I'm pretty sure all of you would be answering the same thing. But for us, let's understand this term management simply in this typical context. We mean two things. When we talk of management, we are talking of two aspects of it. Okay, when we talk of the two aspects, one is raising of resource, that is getting the resources which are required for business, and the second part is utilizing those resources. Right. So that's what a typical manager does. If you take example of any sort of managerial function, be it a production manager, be it a sales manager, be it a HR manager. Trust me, guys, all of them they perform just these two tasks. It's just that I've got a name manager. It means they have to perform these two duties. Now, which are these two duties, sir? One is raising of resources, and other is utilizing the resources. Raising of resources and utilizing of resources. So you talk of a sales manager, you talk of a production manager, they do the same thing. Like if you take a case of a production manager, what are his activities? What is his main role? As a production manager, what are you supposed to do? As a production manager, you are supposed to raise raw material, you are supposed to get the best of labor, you're supposed to get the best of machinery, and those are going to be used to produce the final product. So you're going to get these resources utilized into your business and resulting in an output as the final products. HR manager does the same task. HR manager also raises the human capital or human capital that's required for running of the organization. They pick up the people and place in the appropriate position. They place into their appropriate profiles or roles from which they are able to achieve the organizational objective. Right. So the same set of activities are even performed by the financial manager. Now, in our context, when I want to say raising of resource under financial management, what is the resource that we are talking about? If I tell you, we are talking of financial management, and we are talking of that as a financial management, we are going to see how to raise the resources and how to allocate the resources. So, what sort of resources are we talking of when I talk of financial management? Definitely, sir, over here, we are talking of raising of funds, and utilization of funds, raising of funds and utilization of funds, right? Raising of funds and utilization of funds. Now, if I ask you, tell me from where can you raise the fund? How can you get the fund for your business? I'm talking of a listed company, of a publicly listed company. Okay, let's talk in a very broad sense, not concisely, focusing only to the sole proprietorship. Think from the point of view of a big joint stock company, from the point of a joint stock company which is listed. How can the joint stock company raise funds for its business? What are the different sources? And simultaneously, tell me in which area can the company employ the funds? Tell me the sources of the funds and the areas in which the funds can be deployed or funds can be utilized. Here, guys. I'll wait for your answers in this case. Let me see. Okay, shares, debentures, deposits, equity share capital. Okay, by issuance of shares and debentures. Okay. Uh, if I ask you, give me a broad bifurcation. Give me two class of sources or two broad categories of sources from which you can raise the funds. Give me those two categories. Give me the categories of sources of funds. Yeah. By equity, debt, issuing capital can be sources. They can be utilized for operations. Okay. Loans from banks, preference shares, debentures, deposits. Okay. See, the broad category from which you can raise the funds, there are two. One is the owned funds. One is the owned funds. And second source is the borrowed funds or the borrowed capital. Owned funds and borrowed capital. Right? Both broad category. So any sort of source of funds you take. Anyway, in the post break session, we will see what are the various sources of funds. Even there, we will first start with bifurcating the sources into owned and borrowed. Okay, so any sort of funds you can say, it will be either a owned funds or it will be a borrowed funds. There cannot be any other source other than these two, or it will be a combination of these two. Simple, right? Then, where can I really utilize my funds? Broad categories of investing my funds. Can you tell me what are the broad categories in which I can invest my money? I have raised funds either through owned funds or either through borrowed funds. Now I'm thinking of how to put this money into the business. So what are the broad categories in which I can put my money into? What are the broad categories? Okay, to help you out, we are talking of three broad categories of investment. You can put your money or utilize your funds in three broad categories. Which are those three broad categories? Tell me, guys. Which are those three broad categories in which you can put your funds? Okay. Okay, non-current assets and current assets, investing, operating, financing. No, 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 Karthik. We're not talking of cash flow. Where can you invest? In general operations and investment in securities to expand our business. Okay. Now, I think we got two of the answers correct. It was Aditi, I suppose. Yeah, Aditi. You're right, Aditi. First, we need to invest in the non-current assets, or which we call it as capital assets also. Non-current assets or the capital asset. And second thing is the current asset. Okay. And third category, mind you that these two areas are the areas in which the investment is going to be made, which is related to the business or the operations of the business, right? So you can say that these two are basically the operational investment. Apart from just operations, apart from just putting money into the operations of business, an entity can also invest to earn some sort of other income, and that's what we call it as investments. Investments. Okay. So raising of resources and utilizing resources, two broad categories. Funds can be raised through owned funds, funds can be raised through owned sources or borrowed sources. Investment of funds can be done in non-current assets, current assets, or investment. Normal trade investment, non-trade investment, those all categorizations. We'll learn it as we progress through the subject. Okay. So broadly, our entire, this CA Inter FM course is all about this thing, right? So let me just put certain names of some chapters in front of you, and I'll guide you that that chapter is going to deal you with which activity. So we have the chapters like cost of capital, cost of capital. I'll give you a brief introduction about this chapter, and you just tell me whether that chapter is focused about raising of the fund or utilizing of fund. Okay. Cost of capital, this chapter helps you to understand what is the cost of raising money from different sources. Like if I take a loan from a bank, what is the cost that I incur? If I issue preference share, what is the cost that I will incur? If I issue equity shares, what is the cost of that fund that I raise? So can you tell me this chapter is focusing on which section of financial management? Is it talking about how and where from where to raise the resources, or is it utilization of resources? Right? Correct. So it talks about raising of resources. Perfect. Second, second chapter or second session chapter that we have over here is capital structure. Capital structure. Now, this chapter tells you what should be sort of best combination. What should be sort of best combination of debt and equity, like how much money you should raise in the form of equity shares, how much you should raise in the form of debentures or in the form of bank loan that will be most beneficial for the company. Can you tell me this chapter focuses on which part? Raising of resources or utilizing of resources? Capital structure, which tells you how much debt, how much equity you should have in your business. Definitely, guys, you're absolutely correct. It is raising of resources. Thirdly, third chapter is one of the easiest and interesting, leverages. Now, this leverages, it tells you, uh, what is the level of risk that the company is having based on its capital structure, based on the investments it has made. based on the investment it has made. Can you tell me where does this leverage chapter come in? It tells you how much risk the company is undertaking by taking debt or by issuing preference share, and also how much risk is it undertaking by investing in certain assets. Can you tell where this chapter lies? So this chapter actually lies in between both of them. It tells you something about raising of resources, and it also tells you utilization of resources. It addresses both the aspects there. It tells you what is the financial risk that you will be facing. It tells you what is the operating risk or operation risk that you're going to face. So it targets both the things. Okay. Then fourth chapter. Fourth chapter is investing decision. Investing decision. This chapter tells you that in case of long-term investments, when you want to make a long-term investment, uh, you want to invest in some project or you want to buy a machinery, it tells you whether buying that machinery or investing in that project, is it beneficial to you or not? Should you undertake that activity or not? Should you buy that asset? Should you invest in that project or not? And if you invest it, what is the benefit that you're going to get? Can you tell me? Yeah, so that was absolutely correct on your part, guys. Investing decisions is about utilizing the resource. Okay, then Puja is asking, wasn't the second one utilizing, sir? No, capital structure is not utilizing. Capital structure is talking about just the raising of resources. That is how you are going to raise the resources, how much debt should be there, how much equity should be there. So that's about raising of resources. Okay. Now the fourth one, investing decision, which is about the utilizing resources. Now, fifth one is working capital management. Can you tell me where does this working capital management lie? Because it tells you how much money should you invest or invest in debentures, how much stock you should keep, how much cash balance you should keep, how much amount of creditors you should maintain. It tells you all about those things, or it tells you to estimate, uh, what will be the level of working capital that you will have. So can you tell me what about this working capital management? Is it coming into the raising of resources or utilization of resources? What is it into? What is it into? Working capital management. Absolutely right, guys. You're talking about it. It's about the utilization of resources. Perfect. About utilization of resources. Yeah, it tells about how much credit period to be given, what level of inventory you should maintain. So you're talking of how much funds you're going to invest. Okay. Next one, dividend decisions. Dividend decisions. Can you tell me what this chapter is going to tell you? Dividend decision. It tells you what should be the best level of uh, dividend that you should pay, or whether you should pay dividend or not. Even if you're paying dividend, what should be the amount of dividend that you should pay? So what is this chapter talking about? Is it talking of raising of resources or utilizing of resources? It talks about how much dividend you should pay. It talks about what should be the trend of dividend which you should maintain. Yeah, can you tell me where does it lie? Dividend decision, is it utilization of resources or raising of resources? uh, this is again somewhere in between both, because you need to pay dividend depending on the funds that you have raised. That is, if you're going to have a lot of equity shares into your capital, probably the dividend payout will be a bigger chunk. That's about raising of resources, and also whether you should pay dividend or not. That's your discretion. It's your discretion. It's not mandatory, right? So when it's not mandatory, this dividend decisions are going to be a part of utilization of resources. That if you have got some fund, should I pay it as a dividend or should I invest into my business? That's like a utilizing decision that you need to make. Okay. So then we have a chapter called as ratio analysis. chapter called as ratio analysis. Now, this chapter of ratio analysis, it doesn't lie actually in between these two. It's altogether different thing. It's not about raising of resources. It's not about utilizing of resources. It's about basically financial analysis of a company, right? So it's a altogether different area in which this topic deals with, which is about the financial analysis. How the company is really good, how the company is stable in the form of short-term liquidity, long-term liquidity, profitable, whether the company is doing profitable business or not as compared to the industry. So that discussion is what we have in this ratio analysis. Okay. So this is what the summary of our entire subject is. Okay. This is the practical, all the practical topics that I have taken, summary of the entire, all the topics that we have on the board, right? Now, with a view to having a, concise understanding of what this subject is going to be, let's go ahead with this portion, which is scope and objectives of financial management. Scope and objectives of the financial management. Uh, so first up, what is this? What is the scope of our financial management? What is it really going to be? If I ask you a very simple question, if I ask you a very simple question, tell me value of a company. I'm talking of value of the company as a whole. Okay. Value of the company as a whole. Tell me it is dependent on, or I can say it's a function of what all things. What all things is going to determine what is the value of a company? Yeah. It's going to be a function of what all things. Well, value of a company is going to be a function of where you have invested the money. It's a function of your investing activity. It's a function of how you have raised the money. That is what has been your financing decision. And also, it's a function of the dividend that you pay. The function of dividend that you pay. Okay. The value of a company depends on three things. One, where you have raised the funds, whether you have borrowed, whether you have issued equity shares, whether you have issued preference shares, whether you have taken loan from banks, on what terms you have taken the loan, what's the rate of interest, all those things are going to be into the financing component. Secondly, you would also say, sir, how am I investing that money? Whether I've invested heavily into the capital asset, whether I've invested heavily into the working capital, right? And what other dividends that you're going to pay. Yes, Sai Kumar, I'll be uploading these notes. You need not worry. I'll be uploading it post today's session. Okay. So once I have written everything and all the things are done, I'll be uploading the notes. You need not worry about it. Okay. Fine. So that's about the value of a company dependent on these three uh, parameters. Okay. Now, what do we really have the scope of this financial management? When you take off any finance manager, the role has evolved over a period of time. The role has evolved over a period of time. It's not the same as it used to be like 10, 20 years back. But this role is becoming more and more dynamic because of our interaction, because of finance managers' interaction with lot many other variables that's in the economy or in the company as a whole. Okay. So if I talk of scope, what all things are really covered? Scope of the finance manager. First up, uh, it determines the finance manager is supposed to determine size and rate of growth of organization or rate of growth of the enterprise. That is the first activity that the finance manager is supposed to decide. The finance manager is going to decide what should be the size of the enterprise, what size in the form of market capitalization. Market capitalization is the market value of the shares. What should be the asset base, that is total assets of the company, right? So, and at what rate the company is supposed to be growing. That target has to be set by the finance manager. Secondly, to achieve that target of value of the company, to achieve the target of rate of growth at which I want to make the company to grow, I need to determine then which asset should I invest money. So the finance manager is supposed to determine composition. Finance manager is supposed to determine composition of assets, right? So what sort of assets the company is supposed to be holding? Should it be holding up a typical machinery? Should it get the product manufactured by manual labor or by semi mechanized machinery? So that decision has to be taken by the finance manager. Thirdly, sir, I have decided that I want my company's value to be some X number. For that, I need to invest in so many resources. The next activity comes is, sir, how do I get this fund? So the finance manager is supposed to determine debt equity mix. Finance manager is supposed to determine the debt equity mix. How much debt, how much equity should I come up with? And lastly, but this is not the least activity, this is the most important activity and very cumbersome activity, because that's like the day-to-day thing that the manager is supposed to be doing. So the fourth thing that the manager is supposed to be doing is analyze, plan, and control financial affairs. Control financial affairs of the entity, right? Financial affairs of enterprise, right? So these are the four areas on which our finance manager should work on. That's the scope of the finance manager. These are the four activities that a finance manager, as a finance manager or as a CFO, is supposed to be working on, right? Yeah. So that's what the idea of or the scope of finance manager stands there. Okay. Now, uh, objective. When we talk of objective, and this is going to be a very elaborate discussion. Objective of financial management. We are going to talk about two things. Okay, we're going to talk about two things. One talks about profit maximization. Okay, and the second talks about wealth maximization. Right? Profit maximization and wealth maximization. Profit maximization, wealth maximization. These are the two objectives of financial manager. But slowly and steadily, there has been a transition from the thought process of the finance manager. Nowadays, it's not about profit maximization. It is definitely one of the objectives. But now the focus of all the finance managers across the organization has been to usher method or a calculation by which wealth maximization takes place. Now, for that, we need to have a very clear cut understanding as to what do we mean by profit maximization and what do we mean by wealth maximization, right? What do we mean by profit maximization and what do we mean by wealth maximization? First up, let me ask you, what do you understand by profit maximization? Right? What do you understand by profit maximization? Yeah, waiting. What do you understand by profit maximization? What do you understand by the term profit maximization? Does it mean earning more and more profits? Having more sales, working on increasing the sales, working on reducing the expenses, right? Is that what you understand? Profit maximization? Yeah, yep. To use this in such a way that there is a maximum profit, maximum rate of profit, okay? Making a lot of profits to just more and more profit, increase the profit of company, okay? Excess we get by employing some cost cutting, okay? So we understand profit maximization. We talk of profit as income minus expenses. Right? That's a very simple definition of a profit, which is income minus expenses. Now, there's a problem with this objective. When you're talking of I want to maximize the profit, understand your target is to maximize the profit. The target is to maximize the profit. So, if you want to achieve that target, what should you do with income and expenses? What should you do with income and expenses? Sure, I will try to sell more and more products. I'll try to sell more and more products, or I will try to have like more and more income. And I will try to minimize my expenses by some sort of cost cutting, right? But then just focusing on selling more and more and, focusing on reducing the expenses, ultimately it will hamper you in a long run. Just imagine that the company is very much profit maximization focused and it just tries to, reduce the expenses of whatever means possible, right? So, it wants to reduce the labor cost. So it, it starts hiring the children because they will work for a very lower salary, right? So in place of, qualified labor, you're hiring the newcomer children, you're training them and then putting them into your business. Similarly, to maximize your profit, you are ultimately pushing your salesman to give any sort of offer, give any false promises to your to the customers, because ultimate everyone is focused about what profit, 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 profit. Everyone is talking about profit maximization. Everyone is talking about that we want to make a huge amount of profits every year. So the sales manager is putting pressure on the sales team. Uh, the production manager is hiring, child labor. They are using cheap quality raw material. Tell me, will the company be able to sustain in a long run? It may achieve some profits, maybe a couple of years or maybe 4 or 5 years. But in a long run, what will happen to the company? Is it going to really sustain with low quality of raw material, child labor being employed, false promises being given to the employee to the customers just to lure them into your products? Can you sustain it? Can you really sustain it in the long run? Of course not. So, as I said, that profit maximization is a very narrow-minded thought process in which you say that you want the profit to be maximum, but then you're not talking about the long-run circumstances. Moreover, you know what, guys? Uh, you might be already into like ready for uh, almost like CA inter exams are like nearby. So you might be aware that many accountants, or I can say some of the accountants, may be forced to fudge their accounts just to have a greater profit. You don't know this concept of window dressing, right? So just to show your profits in a better way, you go for some innovative accounting style, right? So those innovative accounting style is ultimately going to affect your profit. It's going to increase. On the books, you will say that the profits are increasing. But then in reality, there's no value addition that is happening to the company. So you can, the managers may resort to window dressing and all such activities and try to just maximize the profit, but that will not add value to the company in the long run. Right, guys? So there's a problem with this profit maximization term. First up, it focuses on these three things. Secondly, profit as a term is a very vague, right? So profit as a term is a very vague term because that's really pretty difficult to understand. What profit are you talking of? Are you trying to maximize your gross profit, your net profit, your profit after tax, your profit before tax, or are you trying to maximize your operating profit? It's a very vague term, right? It may consider your opportunity cost, it may not consider your opportunity cost. So that's basically a very vague concept, right? Thirdly, we say some of the limitations or the problems of profit maximization that we can face is just looking at profit is not sufficient. Sir. Just looking at profit is not sufficient because if you are likely to get better return, there's likely to be a connected risk with it. Am I right? Sir, I want to earn super profits in the stock markets. Let me invest in very cheap stocks. Let me invest in very cheap stocks on which I have got some tip. I want to invest and earn profits out of it. So your focus is very wrong because you're just looking at the profit involved in it. Understand the risk also, right? So profit maximization cannot be understood in isolation without taking into risk into consideration, right? So profit maximization should also consider risk. So we should also consider the risk involved in it. Profit maximization should also consider the risk involved in it, right, guys? Yeah. So how much risk is involved? A project may be very profitable, but you're not paying due attention to the risk involved in it. You should look at the risk and then take a decision whether I should invest or not, or whether I should take up that project or not. Right? So along with profit, you should look for risk. Okay. Then, as we say, profit maximization is a very narrow term. It's a very narrow term because it just talks about profit. It doesn't talk about morals, ethics, understanding the interest of uh, the your stakeholders, like your employees, like your uh, shareholders, your debenture holders. You should take care of all of them because those are the people who have helped you to grow your organization. So just putting a focus on profit is not going to be serving the purpose. You cannot survive for long if you are going to be so narrow minded. You need to take everything together for the growth of the company. Mind it, guys, whenever you talk of any well established organization, it's well established organization, it always takes each and every stakeholder into consideration. If you don't consider all your stakeholders as one family, you will not be able to grow. Okay, you'll not be able to grow. So that's about the profit maximization, which is the age old concept, which is now slowly transitioning into the wealth maximization or value maximization concept. Okay, value maximization concept. Now, what is this value maximization concept. When we talk of wealth maximization, one thing that we need to understand is that wealth is what? Tell me, guys, what do you mean by wealth? Let me see what is the understanding of your term wealth. Because profit, as you have properly said, is the income minus expenses. Tell me, what do you mean by wealth? How do you compute the wealth, by the way? What do you mean by wealth, or how do you calculate wealth? How do you compute the wealth? Or what is your understanding about wealth? Is it the total value of the shares that they have? Is it the total value of assets that they hold? Yep. What is your understanding about the wealth? Yep. Punji. Okay. Karthik is saying Punji, financial assets available, benefits less cost. Wealth is nothing but properties. Okay. Sai Kumar is saying wealth is nothing but properties. Akash Neil is saying wealth refers to assets owned by the enterprise. Okay. Sneha is saying your equity. Namrata is saying net worth. Okay. Well, wealth, guys, I can say wealth is simply present value of benefits. Whatever benefits you are likely to get in future, whatever benefits you are likely to get in future, take a present value of it. That is, take the current value of the benefits that you have. From that, reduce the present value of all your future costs. Okay, so it's about present value of benefits less the present value of cost. Right? So in future, it's a very futuristic concept, right? It's a very futuristic and a long-term concept wherein you're saying in a long run, what is the benefit that you're going to get? And in a long run, what's the present value of cost? What is the cost that you're going to incur? The wealth maximization is about these two things: present value of benefit, less present value of the costs. Okay. Now, when we want to say wealth, when we want to say the wealth, we talk of cash flow approach. We talk of cash flow approach and not accounting profit and not accounting profit. So in wealth maximization, we want to always think about what is the cash inflow that the company will get. What is the cash inflow that the company will get? We'll not talk about what is the profit that will be made. So how is it really relevant? How is cash flow more relevant than accounting profit? Let me take you an example. Suppose you start a business. Okay. Suppose you start a business. So this is your balance sheet. Okay. And you have the PL. You start a business and you sell certain goods, right? You make a sale of 10 crores. Entire sale is on credit. So definitely, sir, we'll have debtors in our books of 10 crores, right? Sir, how did I make the sale? Where did I go get the goods from? Okay. I'm saying that you purchased certain goods. You made purchases of certain goods, which was costing like 8 crores. But this again purchase was on credit. So creditors you will have in your books 8 crores. Wow, sir, we made a handsome profit. Let's say there's no stock, there's no opening stock, no closing stock, no other expense. We made a handsome profit of 2 crores. Sir. And so this is our profit. Profit of 2 crores. So this 2 crore will come in our books as reserves. Right? Now tell me, have you really realized this profit? Sales on credit, purchases on credit, and you're having a profit of 2 crores. Have you really obtained or have you really earned this 2 crores? Have you really earned this 2 crores? Will you go to a bank and show this balance sheet to a bank and ask for a loan? Will the bank provide you a loan for this? Is the bank going to entertain your balance sheet and P&L in this case? The bank going to entertain the balance sheet and P&L? Of course, no. Profit is unrealized. I'm not having any profit. Just the documentation is there. What has come to my bank? Nothing there. That's the basic difference between accounting profit and the cash flow approach. So if this is the type of company in which there is great amount of sales, there's a handsome amount of purchases and superb amount of profit available, but sir, there is no cash inflow. In bank, you don't have any money coming in. In bank, you don't have any money coming in. So we say the profit of 2 crores is just a sham. It's a useless profit. It doesn't make any sense because it stands nowhere. You can't realize this profit. I cannot enjoy this money. I cannot reinvest this money anywhere. So that accounting profit, always remember. So you're talking of a value, wealth maximization, wealth or value. We say wealth or value of a company is simply, you know what? It is the number of shares multiplied by market price of each share. Or you can say, or it is the value of equity shares. And if the company is having debt, even you will consider value of debt. Okay, let me ask you a very interesting question, guys. Let me see how many of you can really understand it. Yeah. Let me understand. Video was stopped for a while in between. Okay, why? Okay, Karthik is asking why unrealized. It can be enforced. It belongs to the enterprise. So whether or not later it will come to enterprise. As of now, it is not realized, na Karthik. This amount of 2 crores, as of now, it is not realized. And it casts doubt on the sale figures also. It's possible that it's just the book entries. How come you're making a 10 crore sale and you haven't received even 1 rupee against it? Right? Okay. So we say wealth or value of an entity is simply number of shares multiplied by market price per share, or I can say one share price multiplied by the total number of shares that the company has. That's the wealth, that's the value of the company if it's not having any debt. Now, if the company is having debt, you will say that the value of equity plus value of debt. You say that it's the value of equity plus the value of debt. Okay. So if you have debt in your company, your wealth, company wealth, that the assets that the company is having, present value of all of them should be like a total of them, right? But let me ask you a very interesting question here. Can any company be having losses? As of now, the company is into loss making. Company is not having any profits as such. Can any company have losses, still be valued very handsome? Is it possible that company is not having any profits nowadays in current scenario? Companies having losses, companies running into losses. Still, it is having a very hefty valuation, very enormous valuation that the company got. Value of the company is very large. Is it possible? Yes. Is it possible that company is into losses or maybe very meager amount of profits, but the valuation is very hefty? Valuation is superb. Is it possible? Because if it's possible, then you should understand so profit maximization is no more objective now, because nowadays our objective is wealth maximization, and therefore we are focusing more on creating value rather than creating profits, right? Correct, exactly, guys, exactly. So we have like Siddharth Muduliar is saying Paytm, sir. Correct, exactly. Prabhas is also saying yes, sir. It's because of previous profits and operations. Yes, yes. Durga is also saying yes, yes. Definitely possible, sir. Even if your profits are negligible, even if your profits are negligible, or even if you are loss making, still you can have a very good amount of valuation, right? Most of the startups are actually loss making, but are creating wealth. Now, what is the source of that wealth creation, guys? Doesn't it sound you absurd that, sir, how come I can have a wealth like it's not earning any profit, how is it still making a great valuation? How is it possible to have that huge amount of valuation even if there are no profits? Yeah, how is it possible? Mostly startups are loss making but creating wealth. Okay, listed companies. Tanvi is asking, do we have two formula for calculation of wealth? Yes, Tanvi, we have both of them. This is, you can say, a company wherein no debt is there, and value share to market price per share is itself the value of equity. Moreover, you have value of debt, you add to it. Okay, so I'm getting the answer to my questions. Um, how is it that adding to the wealth, people like us are wasting money in share market and buying those stocks? That's your personal choice, Siddharth. If you have invested into Paytm, company has monopoly, then valuation can be huge, as in case of Indian Railways. Okay, leverage effect, uniqueness of product selling, future estimation of profitability, profit, increasing customer satisfaction. Shares are valued high due to speculations. Okay, based on their past performance, profitable in future. Exactly, guys. See, in this entire universe of finance, everything is based on future potential. Okay, if you say that my future is bright, uh, you'll say that I've got a very good valuation. And if you're able to convince someone that your future is bright, you've got a very heavy valuation, right? Let me just take you on a lighter note. You all guys are doing the CA course, right? And I hope you understand what sort of value you have right now in your society, in your family, right? In your family, you might be having a very heavy valuation. Okay, this child is doing CA. So is your value greater than a normal BCom guy or a normal MCom guy or normal any other course, right? A normal university degree. Is your value high in your family circle? Yes or no? You're doing TA, right? You are a TA student. So are you being valued in a better sense? Your family members are telling your younger ones that uh, look at your big brother or sister that he is doing CA. So is high value being assigned to you? High value and high expectation, right? Now, what drives that high expectation and high valuation that is attached to you? Because they assume, they estimate that this child is going to clear CA in next 3 years, and he will come ahead with a prefix attached to his name. That's the value which the people are assigning to you. That's a high value. Right? So future potential basically they are saying. Now, as of now, if you consider current scenario, um, you're good for nothing, right? Because you don't have any degree, you don't have any prefix attached to your name, but you're working for bringing that prefix. You're working for the future thing that going to be there 3 or 4 years down the line, right? So we're saying that future is what drives your value. If you see that your future is bright, that will add value to your organization. That will add value to you, right? So this is what we simply mean by the wealth maximization. Remember, wealth maximization is a futuristic thing. It always talks about the future things, future aspects. Okay. So now there are some stark differences between both of them. Let's try to understand simultaneously. In case of profit maximization, we are looking for a target of large amount of profit. In case of wealth maximization, you will always work for achieving highest market value of shares. In case of profit maximization, that's short term in nature. You can say that's short term in nature. Wealth maximization concept is a long term concept. It's a long term, right? Then you can say profit maximization. We don't consider risk. Risk is not considered. Whereas in wealth maximization, risk is taken into consideration, right? Then, in case of, we don't consider here time value of money. In case of wealth maximization, since we say we take all the present value of it, right? So it's a time value of money not considered in profit maximization. Whereas in wealth maximization, we consider time value of money. Time value of money given due consideration, right? Then uh, profit maximization. Uh, it talks about it requires immediate resources. That if you have a project that's going to give you a huge profit, you need immediate resources. Whereas wealth maximization, you can say no clear relation. There exists no clear relation between. There exists no clear relation uh, finance decisions between finance decision and share price. Okay. Wealth maximization, profit maximization, you can say it is easy to attain, but wealth maximization is difficult, right? That's going to be a difficult task for it. Okay. Yep. Do you have any queries? Risk not considered in profit maximization. See, I gave you the example, Namrata. Risk not considered. We said that when we want to maximize the profit, we would like to manufacture low quality, inferior quality products, or employing, child labor into the production activities. So that will ultimately, right, that will have a long term impact on our process. So we are not taking into account the risk that we are taking, right? So we just want to say that short term profit, we want a short term profit. We undertake those decisions, right? Is it right? Karthik is asking, is it right to say that profit maximization also adds value, but in return, it takes much higher value from us, and that is why it is less important now. Yeah, you can say it may, profits may add some value, but then we don't consider only the profits, the book profits. We consider the cash flows, right? Yeah. Then one point I said is there's no clear relation between finance decision and share price. Like if you take some finance decision right now that you're going to invest in some project, that will not immediately translate into higher share price. It will take time for the share price to adjust to your profits. Like The share price will look, the shareholders in the market will look how your project is undertaking, how your project is being performed, and then on that basis, the share price may increase in a long run. But just because you have taken a financing decision now, may it investing or be it raising of any resources, that will not immediately impact your share price. So that will not be immediate impact on the share price. It will take time for that financial decision to show its results in the share price. When you start making some good cash flows, then it will start making some sort of sense, to increase the share price. Is it clear? Namrata, Tanvi, are we good with this point? Yeah. Okay, fine. Perfect. So that's about wealth maximization and the profit maximization. So understand that our focus right now is about the wealth maximization and not profit maximization. Yeah. Okay, fine. Now, um, role of our finance executive or any finance professional, as I said, it has evolved over a period of time. We are no more just involved into day-to-day activities. We are going to interact as a finance manager. We are supposed to be interacting with other things also. So that's the changing scenario. Another important aspect in this thing is risk versus return. What is your general understanding about relation between risk and return? Is it a direct relation or is it an inverse relation? Yeah, risk and return. Can you tell me, is there a direct relation between risk and return or inverse relation between risk and return? Yep. Some queries, highest market value shares, how if our decision is not clear. The decision that you take that should, Aditi, the decisions that you take that will ultimately translate to your share price, right? If you've taken good decisions and you're making good cash inflows for your company, that will ultimately translate to high share price. But that translation of your decisions to share price is not going to be very easy. It will take some time for the market prices to adjust, right? That's what I said in that case. Okay, direct relation, direct. More risk, more return. Perfect. That's a direct relationship. Okay, perfect, guys. So we say definitely, sir, high risk is high return. Because if by taking high risk, you're making lower return or you're making lower profits, then it doesn't make sense at all, right? By taking more risk, if you are saying that I'm not going to earn sufficient returns, I'm not going to invest into it, right? So I'm talking of rational investors. Okay, I'm talking of very rational person, not the irrational one. Irrational one can do anything, right? So we say that there should be risk and return. Both of them should go together, right? There are irrational people in this world also in this globe. You find irrational people. How many of you have seen the movie of Fir Hera Feri? I hope you have seen it. Fir Hera Feri, one of the classic comedy. Yeah, have you seen Fir Hera Feri? In that there is a character of Mr. Raju. Do you call that person a rational guy who follows this rule of high risk, high return, or is he someone who is irrational? Yep. Do you call that guy a rational one or an irrational one? Of course, he's irrational one. Those who haven't seen it, when you have like when you are at leisure, you can look at that movie. That's a entertainer. You can say that you will laugh your belly out while looking at that movie, right? So that guy Raju is a purely irrational guy because he goes to that Lakshmi chit fund and sees that building is under construction. One, they have the policy of minimum 1 crore investment. 21 days, the money is going to get doubled, right? And if you could remember the other guy, uh, the Sunil Shetty. What was his name? Raju and Sham, right? Yeah, Sham asked that lady that what is your business secret that you make the money double in 21 days. So she answers that they invest in some other company which gives them return in like 7 days double. So that's a lighter note. But then the action doesn't seem to be a rational one because if you want a higher return, definitely the risk also involved will be higher. But he didn't look at the risk at all, right? He didn't look at the uh, risk at all. So he invested in a fund which gave 21-day double. In 21 days, the money was supposed to be getting doubled, and he invested into it without looking into the scenario. Yeah. So without looking into this scenario, he invested into it, and he's a totally irrational guy because he's taking great amount of risk, which he is totally ignoring and just saying that okay, I'm very happy that I can get the money doubled. Moreover, he's not just investing his own money into it. That guy is borrowing money from others, promising them that he will double their money in 25 days. This concept is, basically borrowing money and investing in a very risky project, right? Right. The company, after that closed down and all of them suffered the losses. And then the other story followed. So that's an irrational thing that happened. But we are talking over here of a rational person who will take decision based on considering both risk and return. Definitely higher risk, we will expect a higher return. And if there's a lower risk, we will get a lower. A very simple concept. If you want to go for uh, two companies, let's say State Bank of India and a normal cooperative bank, where will you find the FD rates to be higher? In a State Bank of India or in the cooperative bank? Where would you find the rate of interest to be higher? Of course, the rate of interest is going to be higher in cooperative bank and comparatively lower in State Bank of India because of the risk involved in it. The risk in State Bank of India is almost negligible because in industry practice, we take State Bank to be a risk-free entity because it has got a government backing. It's almost like some of the functions of RBI are also delegated to SBI. So we say risk is very less. Cooperative banks, you find the risk is very high, and therefore you'll find that the rate of interest over there is also substantially higher, right? So in a cooperative bank, you find a rate of interest higher because of the greater risk involved. Okay, so understand this very simple concept of finance, guys. You cannot earn substantial profit at a lower risk. If you can do it, it means there is something wrong or imperfect thing in the market. There is something imperfection that exists in the market as compared to what you are earning. Okay, and if you are able to exploit that imperfection, you are the king of the market for that transaction because you are able to identify that imperfection and exploit it to your advantage. Otherwise, anyone in the entity, anyone in the market is going to get the normal return. Okay. Now, coming to the next point of this chapter, which is about agency problem and the agency cost. Agency problem and agency cost. Now, this problem and the cost that arises from it, this problem and the cost that arises from it, it is because of the setup between setup in a joint stock company. Understand that in a joint stock company, the owners are different and the managers are different. In a joint stock company, you'll find owners are different and managers are different because owners are basically the shareholders of the company. Right? Owners are basically shareholders of the company, but the persons who manage those entities or manage the joint stock companies are separate persons. They are like CEOs, right? CEO, CFO. They work for that organization. So, what is this agency problem and agency cost that we are talking about? So we know there's a principal agent relationship between the managers and the owners, which is said to be prominently as a agency problem that we are going to talk. So, in a joint stock company, owners provide funds to the company. But then on the other side, there are managers who are going to manage the business. Now, both these stakeholders in the entity are having different interests. They have different interests. They will try to interfere in each other's matter just to suit their need, right? Because understand, owners over here are interested in long-term perspective of the company. They are interested in long-term profits of the company, that is long-term wealth creation. Managers may be interested in just short-term, right? So when the objectives of these two entities, of these two class of stakeholders of the company, they are not aligned with each other. Okay, so they're not aligned with each other. Then you say that the agency problem comes in. As a owner, you want to do something. As a manager, they want to do something, right? Uh, for example, if they look at a project is to be undertaken with a investment with an investment of, let's say, 1,000 crores, with an investment of 1,000 crores. Now, of course, when you're going to invest such a huge amount, some money will come from owners and some money has to be borrowed from the market, right? Now, when they see managers that this project is very much lucrative, we should invest in this project. We should, borrow money, invest over here, will make profits. But then, are these managers really the risk takers? No, sir. Risk takers are the owner. They are the risk takers. But so, sir, taking loan will not affect any ways to the managers. Managers will be like, okay, let me take a loan. I am not supposed to pay back the loan. It's the owners or the company as a whole who is going to pay back the loan if the project fails. So managers will be very much excited to take the loan and start the project, because of which there will be substantial profit. So this project will give you substantial profit, and when it is giving you substantial, when it is likely to give, I'll say likely to give substantial profit, managers' salary depends on profit. So they will be like, okay, let's go ahead with this project because it's going to give us substantial profit. That's going to provide us a great degree of profit. So managers will say, let's borrow money and invest in this project because we can see a salary hike in that. Risk. So that's where the conflict arises now. That's where the conflict arises, guys. The managers want to invest in this project because of substantial profit, because they want to get salary based on the profit. The owners are not in a position to approve this project because they see that there is a risk involved in. There's a greater risk involved in it, and they're not ready to bear that risk. They're not ready to bear that risk, and that is where the agency problem comes in. Right? That's where the agency problem comes in. Managers want to do something, owners want to do opposite of that. That's the agency problem comes in. It's not regard to only project. It's even regard to the day-to-day activity. It's even regard to the payment of any expense or purchase of any machinery. So they both of them can be at loggerheads. Both of them can be in the opposite direction, and that's where the problem arises. And if we have such problems in an organization, that problem will not that organization will not survive for long, right? So how should we ensure that the interest of both these are aligned? How should we ensure that interest of owners and managers are aligned? How can we do that? How can we do that? Yep. What can we really do? What can we really do that managers should be aligned with the owners? Okay, video got now it's okay, na? Yeah. So I was saying that managers are having objective of having substantial profits by investing in a project, but owners are not ready to take it because of the heavy risk involved in it. So they are at in the opposite direction. So when we have such fight ongoing in an organization, that organization will not be able to survive for long. So how do we ensure that these sort of conflicts doesn't come? We can avoid these conflicts. Ways to resolve this agency problem. One, salary linked to share price. See, when you're linking your salary to share price, uh, their objective will be to increase the share price. And see, share price is about wealth maximization. It will take into account both risk and reward. It will take into account both risk and reward. Right? It will take into account both risk and reward. And if the rewards are better as compared to the risk, then only the share price will increase. Then only the outside investors will be ready to invest in your company. You should link your salary to your share price. Moreover, you can say compensation linked to profits partially and to long-term results also. So we can say whatever compensation or whatever salary we are going to pay, that is going to be linked to the current profits that are, and then in involving your employees into your decision making, making them part owners of your business, right? Best way to understand that this agency problem doesn't arise is to look for some organization. Like if you're aware of Mumbai Dabbawalas, have you heard of them? It's an organization of individuals who deliver tiffins from homes to the offices in Mumbai. Right? So Mumbai Dabbawalas, you can take an example. Ledger Papadi is another example wherein you don't find this agency problem. Because you know what? Every employee or every member in that organization becomes the owner of the organization, some sort of. So when you put both the roles into it, that you are a manager, okay, you will be getting salary, plus you're also owner of it. You're also owner of it, right? So those sort of organizations, you won't find any agency problem because all the organizations, the 800,000 or the thousands of the employees, they work for the one single objective, that is a growth of the organization, right? So these are some ways by which we can agency problem can be solved, by which you can make them a part owner, involve them in long term results also. In that way, the agency problem and agency cost will be reduced. Okay. So now let's take a break, guys. After the break, we'll begin with the next part of our session, which is about sources of finance. Okay, guys, let's take a break now of 10 minutes. Yeah. Okay, welcome back, guys. After the break, let's go to the next section of our discussion, which is about the sources of funds, or what are the sources from where you can get the funds. Let me address some of the queries. Karthik is asking, I'm confused how the share price ensures cash inflow. No, Karthik, you're just taking it other way around. If you have good cash inflow, that will lead to higher share price. Apart from just book profit, if you have cash profit, that is whatever you are selling, you're able to realize it, right? So if you have a greater degree of cash realization, that will lead to greater wealth maximization. So wealth maximization will not lead to higher cash inflow. Okay. Can the objective of FMBG is maximizing shareholder stakeholders wealth instead of shareholders wealth? Yes, you can say, Mantra. Now, let's go for the sources of funds, right? Now, I've done this task for you. This one page is, covering the entire, this one typical page that we say is going to cover the entire chapter of sources of funds. Okay. So it's something which you can just zoom in and look into it, right? Yeah. So let's get started with it. First up, coming to sources of funds. What are the two types of sources of funds? Sources of funds can be either they will be owned funds, or the borrowed funds, right? Radhika is saying just like shares having more risk but having high return, and debentures have low risk and low return. Correct, Radhika. Shares have more risk, therefore the return that is expected on it is higher. Can goodwill be included in wealth? Yes, you can say, which is if your company is having a greater degree of goodwill, that will obviously lead to wealth maximization because that will increase your share price. Okay, fine. The sources of funds, we have borrowed funds and the owned funds. Let's talk about the owned funds first. Okay, so owned funds comprise of two things. One is at the domestic level and other is at the international level. So you can issue owned funds at domestic level or at international level. So first talk about domestic level. In domestic also, we have two things to be learned. One is the external source of equity and other is the internal source of equity or owned funds. The external sources can be equity share capital and preference share capital. Equity share capital and preference share capital. One is equity share capital and other is the preference share capital. These are the two domestic sources of external sources of funds. Internally also, whatever profits the company generates, that company reinvests into the business. That's called as the accumulated profits being plowed by the company back into the business. And obviously, the retained earnings, the profits which are not distributed to the shareholders, those are ultimately belonging to the ordinary shareholders and increases the net worth or the value of the company. Okay, so that's about internal sources. Now, external sources, equity share capital and preference share capital. We know that equity share capital is a source of permanent capital. Once you raise money through equity shares, they're not supposed to return it back unless and until the company is wound up. There is no obligation on the company to pay it back at a regular interval, right? It represents the ownership. Moreover, it is having the residual interest in income and assets. Now, what do you mean by residual interest in income and assets? Whenever the company generates any profits, after payment of debenture interest, after payment of preference share dividend, after payment of all your expenses, what is left over, that is what is given to the equity shareholders. And therefore, we say we always get the last chunk of profits, whatever is left over, in the profits as well as in the asset at the time of company being liquidated. Equity share capital, remember, it has got the highest cost of capital. Equity share capital has got the highest cost of capital. You will say, sir, how come in case of equity share, we may pay or dividend or we may not pay dividend? How is it really costly? To understand, equity share capital, when you are issuing to the market, your equity shareholders have some expectation. If their expectations are not matched, what are they going to do? What are they going to do? Tell me. You issued equity share capital. They had some expectation in their mind that they wanted either to receive dividend or an increase in the share value. Now, if you're not meeting their requirements, if you're not meeting their requirements, you are not able to achieve a higher market price, nor you're able to generate profits and give dividend to your shareholders. What are those shareholders going to do? What are those shareholders going to do? Tell me. What will those shareholders do if you cannot meet their expectations? What's going to happen? If you're not able to meet their expectations, what's going to happen? Yeah, they will simply dump your shares in the market. They will dump the shares of the company in the market, and that will drive the value of the company down. And that's a very big cost. That's a very big cost for the company because if the share price goes down, that will have a spillover effect. Your bankers will start doubting you. Your employees may not be confident on you. The creditors may not be ready to give you credit, right? So that will have a spillover or a chain reaction effect, which no company would like to have. Any company would like to have a increase in the share price rather than a fall in the share price. So all the companies are targeting that they should be able to achieve the highest possible share price, best valuation for the company. That is possible only if you meet the expectation of the shareholder, and that expectation is a very huge cost to the company, right? And moreover, these equity shareholders are very shy people. They never express what is their expected return. You are supposed to be knowing what is their expected return. You are supposed to be knowing what is the return that they need. And if you don't meet their return, they will dump the shares. And that will again, an indication, okay, possibly I'm not able to generate sufficient profits for my equity shareholders, and therefore the share prices are down. So I need to work harder. I need to take more prudent decisions so that I need to make more, sound decisions through which I'll be able to attain greater profit. So that's the reason we say that equity shareholders are having high cost as compared to the debentures, because debentures, they always tell you what is the return that they want. They tell you that they want 10% or 9% return. If you don't give them that return, then they will start filing a suit against you. But then equity shareholders are very shy, very silent people. They are the silent makers or killers of your company. If you meet their expectation, they'll make your day. You don't meet your expectation, they'll break your day because they'll just dump the shares and then drive your company, your shares into the lowest possible value. Right? Therefore, we say that it has got a high cost. And then if it also provides security to other fund providers, equity share capital, it provides security to other fund providers. Like, for example, if you say, uh, any company that has a capital of 10, or I can say any company where you find that equity share capital is 10. Yep. Right. Yeah. If we give you two options, one of the companies having equity share capital 10, debenture 90. And there is another company with equity share capital 50, debenture 50. One of the companies having equity share capital 10 and 90, other companies having equity share capital and debenture 50-50. Tell me, in which company would the debenture holders be more safe? In which company would the debenture holder feel more secure? Is it in the case of the first one or is it in the case of second one? First one, there is the equity share capital of 10, debenture of 90. Second one, there is 50-50. Where would they find, the debenture holders find themselves to be more secure? In case of 1090 or in case of 50-50? Of course, you're absolutely right, guys, in case of 50-50, because here they would say that I am just a 50% debenture provider, rest 50% is provided by the owner. So it actually indicates that owners are having confidence in their own business and therefore they're putting in substantial amount of money, right? Perfect, correct, right? So therefore we say that it acts as a security to other fund providers. It acts as a security to other fund providers. Now, advantages: permanent and irredeemable. It increases the financial base and help facilitate additional borrowing. So as I said, if you have more proportion of equity shareholders, it gives a greater degree of security. So if it gives you a greater degree of security, that will facilitate additional borrowing, no obligation to pay dividend, and also it can be equity shares. From the equity shares, you can get additional funds by way of rights issue. I hope you guys are aware about rights issue, correct? You guys are aware about rights issue. Rights issue is the shares that are issued. Rights issue are the shares that are issued to whom? Rights issue are the shares that are issued to the existing shareholders. That are issued to the existing shareholders for a price which is at a discounted price as compared to the market. Right? So if you want additional funds, you can also issue. You can raise those funds through rights issue. Disadvantages that the equity share capital has, it's disadvantages to the shareholders because whatever is the dividend income that is taxable in the hands of shareholders. Shareholders need to pay tax on. Sir, it's a risky investment. Moreover, tell me what will happen if you keep on issuing more and more equity shareholders? What will happen if you issue more and more equity shareholders? Let's say earlier you had 1,000 equity shareholders or 1,000 equity shares. You have issued large number of equity shares and now it has become like 10,000. What will be the repercussion or implication of this? Earlier, you had 1,000 equity shares outstanding. Now you have issued a lot of other equity shares, and now the total number of equity shares become 10,000. What will be the repercussions of this? What repercussions can you imagine about this? If you issue more and more equity shares, what's going to happen? Yep, guys. Yeah, ownership will get diluted. Exactly. Karthik, you're absolutely right. Ownership will get diluted. More people will have control, more equity shares, and EPS will get reduced. Correct. So earnings per share, it's like when you had 1,000 shareholders, the profit was distributed between 1,000 people. Right. So each of the shareholders are getting 1/1,000 portion of the profit. Now, when you have 10,000 shares, the profit will get distributed between 10,000 people. And every owner will get just 1/10,000. Right. So you can say in the first case, each of the shareholder was getting 1/1,000. That means 0.1% stake. And now when you issue more number of shares, that becomes 1. Not 10,000, that is 0.01% stake. So that's like dilution of the ownership and also earnings per share, profit that you are getting per share, that will also get reduced. So that's a disadvantage of our equity shareholders. Okay. Then coming to the preference share. So preference share capital is a typical hybrid form of financing. So preference share capital is a hybrid form of financing in which we say, it has got features of equity as well as debt. In the form of equity, it's that they are part owners of the company in a sense that when the company gets liquidated, they will be paid after the debenture holders are paid off. Right? They will be paid only after the debenture holders are paid off. And in the form of a debt, I need to pay them a fixed amount of dividend, right? So rate of dividend, generally we say it is higher than the rate of interest. Can you tell me why the rate of dividend is higher than rate of interest? Namrata, hybrid means it has got characteristics of both equity as well as debenture. Okay. Now my question is, can you tell me why is the rate of dividend higher than the rate of interest? Like if the company is issuing debenture and the company is issuing preference share, in preference share the rate of dividend is higher. Why is it so? Can you think of a possible correct answer for this? Can you tell me what is the reason for this? What could be the reason that preference shares demand a higher rate of dividend? Yeah, can you guys tell me? Risk is higher. Absolutely correct, Tanvi. Risk is higher. Uh, the in case of preference shares, since they are a type of equity, they will be paid capital at the time of liquidation only when the debenture holders are paid off. And therefore, we say preference share capital has got a bit of higher risk, and therefore more dividend has to be given to them. Perfectly. Some of the types of preference shares that we have, they can be cumulative, non-cumulative, redeemable, participating, non-participating, or convertible. Let's understand each one of them in some brief. Uh, Cumulative preference share and non-cumulative preference share. What is cumulative preference share? Uh, Cumulative preference shares are those preference shares, in which the debenture, sorry, not the debenture, the dividends get accumulated over a period of time. Like if the dividend is not paid in the current year due to lack of profits, that will be paid in the next year along with next year's dividend. So dividends keeps on accumulating, and therefore that's called as a cumulative preference share. Non-cumulative preference shares are those preference shares in which case the preference shares does not accumulate, or the dividend on preference share does not accumulate. Like if this year we don't have profit, you won't be paid any dividend. Next year you will be paid dividend only for the next year profits, not for the past year profits. So yeah, over here the dividend doesn't get accumulated. Redeemable, generally all the preference shares are redeemable. Either they can be redeemable or they can be convertible. Redeemable means they will be redeemed for cash. And convertible means your preference share will get converted to equity shares on maturity. Participating and non-participating. Participating means they will have access to, or they will participate, they will take a share of equity shares profit also, only if certain criteria is met. For example, in case of participating preference shares, we may say that if profit of company is greater than 10 crore, then preference share will get 1 crore share. Right? So we have put up a condition that suppose if the profits of the company are greater than 10 crores, if the profits of the company are greater than 10 crores, then we will invite the preference shareholders and ask them to share their 1 crore profit extra over and above 10 crores, then only. So they participate in the equity share profit, and therefore they are called as the participating preference shares. And if they cannot participate, that is, they don't have any right to the profits of the equity shareholder, then those are called as non-participating. Okay. Non-redeemable preference shares are the convertible preference shares or something else. Non-redeemable are generally not existing nowadays, but generally what happens is if you don't want to redeem your preference share, you can convert it to equity shares. And generally speaking, if it is non-redeemable or irredeemable preference share, it means you're never going to return back the principal. You'll just keep on paying the preference dividend. Okay. Yep. Fine. Some of the advantages that we have, there is no dilution in the EPS because as you issue the dividend, the preference share, you need to pay a fixed amount of dividend. There is no dilution in EPS happens. There is this advantage of leverage. What is this advantage of leverage? I would like to just you to just put this leverage into your mind. By the way, this is a proper term. It is called as leverage. Okay. Just put this term in your mind as a memory plus function because it's not possible to explain this concept of leverage within a span of 5 minutes or 2 minutes. It will take around longer duration. So when you will learn the chapter of leverage, then you will connect this point that when you take preferential, you take advantage of leverage, right? Yeah, Namrata, correct. When you have that will be 1 crore profit plus the dividend. Participating preferential again. Participating preferential means you will give a target to your preference shareholders that if your profit is greater than, let's say, greater than or equal to 10 crores, then preference shareholders will get 1 crore share in profit. That is normal preference dividend, whatever they have paid, they will be paid. And if I have super normal profits, extraordinary profits that I have made, the excess profit which I have, in that excess profit, the preference shareholders can participate. Okay. So they will get extra dividend over and above the normal promised dividend. That's what we say as a participating dividend, participating preference. Okay. There's no risk of takeover because if you issue equity shares in the market and if someone buys your equity shares from the market, okay, like so suppose if you have 1,000 equity shares in total and all of them are being traded in the market, is it possible that someone in the market can buy your shares or buy the shares that are available in the market and kick you out of the company? Is it possible or not? Is it possible or not, guys? If it's a listed company, suppose suppose I'm very rich. I have got, with God's grace, God provided me with some ATM machine that keeps on vending out money to me. And can I take that money and just buy the shares of Reliance Industries Limited and dethrone the managing director of its place and become a managing director of the company? Is it possible? In case of equity shares, yes, it's possible, sir, because if the number of shares in the market are more than 50% of the total shares, if the shares in the market are more than 50% of the total shares, then I can acquire all those shares from the market and take control of that entity. But that is not possible in case of preference shares. Okay. Dividends are fixed and pre-decided, and obviously they are redeemed after a specified period. Disadvantages are like, sir, whatever preference dividend you get, that is taxable in the hands of the equity in the shareholder. Moreover, whatever preference dividend you pay, that is not allowed as a tax deduction. That is not allowed as a tax deduction. So preference dividend, the company that pays the preference dividend is not an expenditure in the eyes of law because it's a appropriation of profits to the owners, and therefore there is no tax deduction available in that case. Okay. Then in case of disadvantages, we can say cumulative preference share. Cumulative preference share. Uh, Cumulative preference shares are something very much problematic for the company because if this year I don't pay dividend, I still have the obligation to pay the dividend in the next year. Right. So that's a problem that we have with regards to the cumulative preference share. So that's a brief about the preference share capital. Now let me go to the international era. If we look at the queries, it means that the share issued in the market are always less than 50% total capital. It can be more than 50%. Aditi. There are certain companies where 70 or 80% of the shares are also there in the market, but there is no single player who can buy those shares. because you need to spend so much money for that. Okay, coming to the international sources, GDR or Global Depository Receipt. International sources are basically GDR or Global Depository Receipt. These are the negotiable certificates held in the bank of one country representing specific number of shares of a stock traded on a exchange of another country. Now, what does this GDR mean? Global Depository Receipt. Global Depository Receipts are basically American Depository Receipts, and we also see IDR. But let's first understand what is this GDR. Radhika, tax not deductible wala point. Tax not deductible means whatever preference dividend you pay, that is not considered as expenditure by the income tax department. Income tax law doesn't consider preference dividend as an expense. So if they don't consider that as an expense, it means your profit on which you have to pay the tax, that is before deduction of the preference dividend. So therefore, they say that they are not tax deductible. Generally, other things like interest you pay on the debenture, that is allowed as an expenditure. That is treated as an expenditure. But preference dividend is not treated as an expenditure in the income tax. Okay, let's come to GDR, Global Depository Receipt. So what is this GDR process as a whole? GDR process as a whole. Let's try to understand it in a very in the form of a chart. See, Global Depository Receipt. Now, if we have, let's say we are standing in India and other is the US market. In India, we have a company called as Infosys Limited, right? Right. So we have a company called as Infosys Limited. It's an IT company. It is listed in India, and the shares are also available in India. But now Infosys wants to go for a global source of fund, or I can say Infosys wants to get funds from the international market. Tell me if Infosys Limited directly goes to US and sells its shares in US, will the investors of US understand what is this share? Will the investors of US understand what are these shares? Absolutely no, because Infosys shares will be having a face value of 100, but in terms of rupee, right? Infosys shares are in the terms of rupee, and investors in US will not understand what the hell is rupee, right? Because they will say rupee we don't understand. They will understand only those things which are denominated in dollars. So now when Infosys wants to access the wide or a large US market, how is it going to access it? How is it going to sell the shares in US? Right? That's not possible by simply taking the shares to the US market, shouting out at the top of your voice below the Wall Street and just calling out that, take this Infosys shares, a very established company in India. No one will listen to you because they don't understand what is rupee. So I need to route it to the US market through appropriate channels. I'll have to route the Infosys Limited shares into the US markets through appropriate channels. Now, what are those appropriate channels? Let's understand it. See, in US, uh, you need to issue this. So you will first take these shares to a depository. Are you guys aware of what is depository? Do we know what the depository is? Do we know what a depository is? Yeah, depository. Do you guys know what is the meaning of depository? No? Yes or no? NSDL, CDSL, okay, intermediaries. Basically, depositories are banks of shares. These are the entities who keep the shares in dematerialized form. Okay, the entire dematerialized shares are kept by the depositories. In India, we have depositories as NSDL and CDSL, National Securities Deposit Limited, Central Depository of Securities Limited, right? So NSDL and CDSL are the two depositories who keep the shares in dematerialized form. They are the bank of securities, the bank of shares. Now, what will Infosys do is it will take the shares and give it to the depository of US. Now, US depository is such a large organization, it will understand what these shares are. So it will accept these shares. Let's say Infosys gave them total of 10,000 shares to depository. Depository will take these shares and it will issue, depository will issue 100 depository receipts. 100 depository receipt. If it issues 100 depository receipt, can you tell me what is the exchange that it has followed? 10,000 shares, the depository is going to issue 100 depository receipt in which it will give an acknowledgement. It will give an acknowledgement that we are in possession of so many number of shares of Infosys Limited. So one depository receipt will be equal to 100 shares. So against 100 shares of Infosys, 100 depository receipts are issued. Now this depository receipt is issued by an organization in US. This is issued by an organization in US, right? Uh, so that organization in US is now established and it is known by the people of US, right? It's known by the investor of US. It's known by the investor of US. So depository receipt means it's an acknowledgement which is given by the depository that that we are in possession of 10,000 shares. Right? We are in possession of 10,000 shares. Against that, it issues the acknowledgement. Now, this acknowledgement, does it have a legal backing in US now? Because yes, it's because issued by an organization in US. It's not something which is issued by Indian company. Okay, that is in lieu of Indian company, but that is issued by an organization in US, and therefore we say depository of which shows 100 depository receipts. Those are going to be which is something recognized in US. Now tell me, will the US investors understand this depository receipt? Because it's a receipt which is issued, it's acknowledgement which is issued by the organization of their country. Are they going to understand this receipt? Yes or no? Yes. Now these shares or these depository receipts will be issued in US market. Now the US investors are having a legal guarantee that okay, organization in US is giving us a guarantee of this share. It means the company is genuine. And therefore, from this, the depository will realize dollars. Depository will send that money to Infosys after deduction of some charges, right? And that will go through RBI, and RBI will provide rupee to Infosys, right? So in this way, Infosys will be able to access the large US market through a depository in US, and that these depository receipts are called as GDR or ADR. Since this is US issued in US, those are called as American Depository Receipt as ADR. Any other country you issue, those will be called as Global Depository Receipt or GDR. Okay. Are we clear with the GDR concept, guys? Are we clear with the GDR concept? 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 Are we clear with the G Are we good with the GDR concept now? It's just a depository receipt against which the money is raised and that's transferred to the original company. Are we good with it? Depository receipt. It's basically simple terms, uh, global equity share. Simple. Okay. Are we good? Shall we proceed? Yeah. That is how foreign institutional investment takes place. Prabhas, got it. Okay, clear. Foreign institutional investment takes place, but here institutional investment is done through GDR, right? Foreign institutional investment, Prabhas, it is that investment which the foreign investors bring into India and they buy directly the shares of India in India only, in India itself. They don't buy it in outside market. Right? So if I am a US investor, I'll bring my money through RBI into the Indian markets and I'll buy the shares in India itself. Okay, that's a foreign institutional investment. This is not a typical foreign institutional investment. This you are investing in the wide US market, right? Infosys is bringing money from US through depository. Foreign institutional investors may what happens is the institutional investors come to India and then they put the money. Okay, so that's the American depository receipt. If foreign companies can come India, they can come to India and raise funds for their country, then those are called as Indian depository receipts. Okay, then coming to the borrowed funds category. Namrata, yes, depository receipt means the acknowledgement given by the foreign depository. Correct, exactly. Now, one more thing I just wanted to highlight about this chart is you will find that I have enclosed some of them and put them into long term or short term or medium term, so that it may help you in understanding what is the tenure of each of these investments. As you say, whatever is the owned funds, those are always long term. The long term and short term discussion comes only in case of borrowed funds. Now, when we have borrowed funds, we have got two wide classification. One is the international and other is the domestic. Now let's understand what are the domestic borrowed funds. Domestic borrowed funds. First, seed capital. Now, seed capital is what? Radhika, chapter 2 finish. No, Radhika, we won't be able to finish this chapter. We'll spill it over to the next session. Okay, as far as possible, we'll try to cover. Whatever is left out, we will take it over to the next session. Okay, seed capital. Coming to first part, seed capital. Uh, Seed capital is something which is provided to the startups, right? So seed capital is the money that is provided to the startups, and generally it's a seed. So when you want to grow a plant, when you want to grow a tree, you will first bring the seed of it, right, and then start watering it so that it grows to a full-fledged plant or a tree. So that's the initial capital which is provided by seed capital. Okay. Uh, Now, since it's a seed capital, since it's a startup company, it won't have, since it's a startup company, it won't have much of cash flow or much of profits to pay the interest. So generally, what we say is, uh, it's an interest free. It's an interest free, but carries a service charge of 1% for first 5 years. It's interest free for first 5 years. You don't have to pay any interest, but yes, there is a service charge of just 1% that needs to be paid. So there's a service charge of 1% that's required to be paid. And then at an increasing rate, so as and when you make profits, this seed capital fund providers will start asking for higher rate of interest. Now, repayment and the rate of interest, it depends on the reaping capacity with a moratorium up to 5 years. Now, what is moratorium? Moratorium means for certain time period, you need not pay any principal back. You have to just pay the interest. You need not repay the principal. Uh, Repayment and rate of interest charge depends on reaping capacity. That is how fast the company is able to generate profit and pay back the money. Right. So that's the seed capital which is provided to the startup company. It's a service charge which is provided on service charge. It's just uh, you know uh, just a sort of nominal interest you can say. Instead of saying it as interest, they call it as a service charge that we have provided you fund against which we need 1% per annum. Okay. Now, zero coupon bonds. Coming to the next part, zero coupon bonds. Uh, these are no interest bond issued at discount and redeemed at par. It means generally what happens in debentures is you issue it at 100 price, you pay interest every year, maybe 10 rupee, and then finally you pay the final instrument, right? So in case of debenture, generally what happens is in year zero, you get 100 rupee, then year one, two, three, you pay 10 rupees, and then at the end of third year, you pay back the 100 rupee principal back to your investors. Okay. Now what happens in zero coupon bond is you don't pay any interest at all during that time period, right? And you issued a discount and redeem it at par. Like for example, you issue a debenture at 100 rupee. Sorry, you issue a debenture or bond at 10 rupee with a face value of 100. So it means you issue it at 10 and redeem it back at rupees 100. But what is the time period, sir? 30 years. So a debenture is issued at a price of 100. So investor pays you 10 rupee and you promise the investor that you will pay him back 100 rupee after 30 years. So during that 30-year frame, nothing will be paid. Those type of thing in which there is no intermediate interest payment are called as zero coupon bond. Right? So these are no interest bond which are issued at a discount, face value of 100, but that is issued at 10 rupees. And those are redeemed at par. So when I'm going to repay back, I'm going to pay back 100 rupees. Now, deep discount bonds are again a type of zero coupon bond. This is a typical deep discount bond. If you see, sir, 100 rupee face value, but issue price is 10. So there is a discount of 90 rupees that's there. There's a discount of 90 rupees that's there. And, the tenure is 30 years. And these are typical deep discount bonds. Okay. Then next, domestic long-term investments are long-term sources of funds are secured premium notes. Secured premium notes, which are redeemable notes issued along with detachable warrants. Warrants need to be converted within time period notified by the company. Now, secured premium notes mean these are a sort of debentures. These are a typical debenture. But on these debentures, you don't pay interest. Okay, on these debentures, you don't pay interest. What you do is, instead of interest, you give them warrants. So what is warrant? Warrant gives you a right to buy the share. Warrants gives you rights to buy the shares after some time. Right? So debenture is issued. Instead of interest, you pay warrants to your investors, which are detachable warrants. So they'll take the warrants, steer it, and keep it with themselves. And those warrants will become shares, will be converted to equity shares free of cost. Right? Will become equity shares free of cost, or maybe some nominal amount will be paid and they will be converted to equity shares. So in short, you can say these are the debentures which are uh, issued for cash, but the payment or the interest payment is not happening in cash. You are giving them warrant or equity shares. Okay. Then another type of domestic long-term funds is loans provided by the promoters. Those are also called as widely quasi-equity. Quasi-equity. Now, loans provided by promoters means it is like loan given by partner to the partnership firm. Similarly, loan given by the promoters to the company is called as the quasi-equity. And sometimes it is required to meet the promoter contribution. Sometimes bankers ask for some minimum amount of promoters contribution. Some minimum amount of that promoter contribution should be there. Huh? Aditi, can we say that security premium is a type of convertible debenture? Yes, Aditi, you can say sort of convertible debenture. So the loan provided by promoters are called as a quasi-equity, and these are sometimes required because when you want to borrow from the banks will ask for what should be your promoter's contribution or some amount of equity share capital to be brought in. Okay. Uh, Sometimes the bonds that are issued, that may be fixed rate bond or that may be floating rate bond. Now, floating rate bond means the rate of coupon, the rate of interest that the bond pays will be fluctuating depending on the market conditions. They will be fluctuating depending on the market conditions. They are used for hedging against interest rate volatility and are issued by the financial institutions like IDBI and ICICI. So these are the bonds on which the rate of interest is not fixed. It'll keep on fluctuating depending on the market scenario. Okay. So we have like some more points to discuss. What are the international sources? Foreign currency convertible bond, advances from customer trade credit, and securitization, export finance, venture capital financing. A lot of other stuff is there which we need to discuss. We are running short of time probably right now. So we'll stop here for the day. We'll take up these sections in the next part. Let me just see if you have any queries. Can you give example of promoter's contribution? What is hedging? Promoter's contribution, Namrata, is when any shareholder gives loan to the company. I am a shareholder of a company, like for example, Mukesh Ambani giving loan to Reliance Industries Limited. That's a sort of promoter's contribution. Okay. What is hedging? Hedging is protecting against the interest rate risk pay, hedging against any volatility. Anything that changes, you want to protect yourself against it. You want to safeguard your interest. That's called as hedging. So if you have like interest payment that is in variable terms, and you want to protect yourself from increase in that, so that's your hedging activity. Okay, more about these topics. We'll take it up in the next class and also followed by the MCQs and questions based on this. And we'll begin with the next chapter also. Till that time, bye bye and take care, guys. See you in the next class. Yes.